Hello, my name is Eddie Tofpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London, UK feed wheat. Paris milling wheat. I have a singular big picture item here on this daily chart that is nearly 2 years old. It is the big June/October 2022 to April 2024 bear channel, currently at 208. It's 208 to well off the bottom of my daily chart. This bear channel is still highlighted in dark blue on my daily chart. It's the only one since mid-April it's only since mid-April this year that we saw it broken on the upside. But it's still so significant that I've kept it highlighted and also still on my daily chart. So it was since the low in early March that the market staged a gapping move higher, admittedly due to changeover, but still a gapping move higher. That's risen up through the green highlighted short medium moving average, currently at 238. Hesitated around the medium moving average, currently 233, enough to form a combined descending triangle and bullish half hesitation, and followed up through the 50% absolute Fibonacci line at 219 and the dark blue highlighted upper bear channel line, currently at 208 of this long time bear channel. Prices moved further up over the long moving average, currently at 229, hesitating for a short while, just under the bright red highlighted neckline extension of the June to November 2023 head and shoulders top, currently at 236, before breaking up through and into the congestion between 252 to 255, containing the 2013 high at 213, utilizing that congestion as support rather than resistance, and moving up through the next 258 to 260 congestion containing the 2022 low at 258, before coming to the latest and arguably most difficult overhead congestion between 267 to 270, where the market was capped at the end of May. In the process of moving higher, the market created a very steep and acute late April to late May bull channel, highlighted in purple on my daily chart. So before I deal with this new bull channel, let's go back a bit to that break of that big bear channel. This break high gives a primary target X for the move up in the 277 area, with the secondary harder to reach target X1 up in the 312 area, which is up off the top of my daily chart right now. So what stands in the way? Well, the obvious current resistance area of the 267 to 270 area has been, I have repeatedly said, this resistance is quite reasonable and quite congested. Beyond that, we have the 2012 high at 279, then the neckline extension of the October 2021 to December 2021 head and shoulders top. Small one, but a relevant one, currently at 294. After this, there's a series of 50% Fibonacci lines, September 2019 to May 2022 move at 302, the August 2020 to May 2022 move at 307, and the March 2021 to May 22 move at 313. Now, before we can realistically start looking at these topside levels, we have to look at the exit from the purple highlighted bull channel and the capping action of the 267 to 270 congestion band with the subsequent decline. The move lower has been quite dramatic and still is. I spoke on this last week and I quote, gives us some new opportunities on the downside without ruling out the larger longer term potentials on the upside. You call this a possible diversion, if you will. Thus, if we have a primary potential target at X2 down in the 244 zone and a secondary and hardest reach target X3 down in the 233 zone. In theory, even dropping down to target X3 at 233 would still keep targets X and X1 above still alive. But I imagine we might have developed some newer patterns by then, should prices venture that far. Would only add that how between the primary target X2 and the second target X3, we have some considerable supports, which I had highlighted earlier when the market was moving higher, notably, and these are notable ones, the bright red neckline extension, the green and rising short medium moving average, as well as the congestion at 234, 238, 240 and 242. Minneapolis wheat. My apologies for some of the labels being highlighted in bright red. Sometimes my charting system throws a wobbler and does this sort of thing unintentionally. So please note, there is no special meaning in any of the labels being highlighted in bright red. Back in late February 2023, and especially at the start of April last year, so that is now outside the parameters of my daily chart, the market constructed a large bear channel that morphed into what is now highlighted in dark blue on my daily chart. A descending, expanding wedge pattern, currently to 719 down to well off the bottom of my daily chart. The upper trend line is currently escorted and reinforced, and has been for some time, and not very well recently, I have to say, by the gold highlighted long moving average, currently at 716. And going back a bit to early December last year, the green highlighted short medium moving average, currently at 697, started capping prices in. Now, in truth, this moving average had been an effective cap on the market since mid-October 2023, not tested, but effective nonetheless. However, on the 22nd of April, after some base building since late February, the market broke higher over the green short medium moving average, as well as the mauve highlighted medium moving average and some other significant resistances in a band between 693 to 708. In this band, we also had two other patterns I'd spotted earlier, nestling like Russian dolls, one within another. 31 weeks ago, I said the following of the first pattern highlighted in purple on my daily chart, and I quote, "It is the nascent late August to date bear channel," and that's currently 668 to well off the bottom of my daily chart. Once again, I note how we have a smaller bear pattern nestled within a much larger one, much like a Russian doll, end of quote. The second pattern is no longer highlighted and is the October 2023 to late April bear channel, currently at 576 to 673. This one has seen some market touches and likewise was also broken. Prices 2 weeks ago exited up and out of the 693-708 congestion band, creating a steep and acute and ultimately short-lived late April to early June bull channel, which is highlighted in bright red on my daily chart. This original break higher gave me the opportunity to consider opportunities topside. Thus, for the big dark blue expanding wedge pattern, we have a primary target X in the 878 area, the hardest to reach secondary target X1 in the 928 area. This second area is well up off the top of my daily chart. For the purple highlighted bear channel, we had a primary target in the 777 area with a secondary hardest to reach target X3 up in the 820 area. The primary target here was just about achieved. For the unhighlighted bear channel, both the primary and secondary targets have been reached. So I'll just let all of that sink in for a moment, and then we'll look at obstacles in a way, preventing the market reaching those harder primary and secondary targets, as well as what has turned the market lower. First off, what had capped the market since last week, and that was the July 2021 lower at 778. Initially, it didn't look that aggressive, but it has stopped the rise and turned the market lower, back down within the dark blue descending wedge pattern, back below the gold highlighted and through the gold highlighted long moving average and through many supports that are now resistances. Below, we now have the green highlighted short medium moving average, currently at 697. And the mauve highlighted medium moving average currently is 687. However, we could easily see prices head back down to the purple upper trend line, currently 668, as this is the area where we have a wide congestion band formed over February to April, roughly between 640 to 675. Now, should we get down there, then it would not be the end of the world for any previous break higher, though it would indicate that the April to June move higher was, for at least the large dark blue descending wedge pattern, a false break higher, and possibly for the purple one, a limited fulfillment of just the primary target. But I think it would be best to see what the market constructs should it get down there before totally retiring those big topside targets. London UK feed wheat. One of the key features here on my daily chart, it's a surprising feature, has been and still is the extension of the neckline of the May to June 2023 reverse head and shoulders bottom, currently 192.25, which is highlighted in dark blue on my daily chart. Originally, this was not a very notable pattern, a mini reverse head and shoulder pattern if you will, but the extension of the neckline first acted as a pretty reasonable support and then later as an additional resistance. though I suspect in the backgrounds when that was happening, the September 2021 low at 181.70, and perhaps more importantly, the 50% absolute Fibonacci line at 180.5 had helped in the past to prop up prices, and now this year in late April, however briefly, to cap prices before possibly acting this week as support again, though how good it will be is debatable. Looking more recently at some of the action, we have seen a double bottom during February and March, and prices moved back up through the old congestion from March to April 2019 between 161.95 to 165.75, as well as through the July 2021 and May 2023 lows, both at 164, and the August 2020 low at 161 even, reaching the target area for this pattern in the 170 even area. We then had some hesitation under and around the medium moving average, currently at 173.25. This medium moving average had been an effective cap for the market since about late 2023, becoming more significant as we headed into December 2023. Moving now to April this year, and 7 weeks ago I posted this question, and I quote, "The question now is what this hesitation we are seeing under and around the medium moving average, what will it become? Will it be a capping and topping action, or a halfway hesitation for a move higher, or as I noted last week, does it have elements of a small sideways triangle?" End of quote. Back then it was too early to say what it would be, but over time it became evident that it was an ascending triangle, highlighted in bright red on my daily chart. From this pattern, prices punched up higher through the top of the ascending triangle and the medium moving average on the 22nd of April, reaching both the primary and secondary targets above. But then the market came into contact not only with the 50% absolute Fibonacci line at September 2021 low, but also the slowly declining gold highlighted long moving average. That's currently at 179.70. At the end of the first week of May, prices punched up through all three of these, establishing itself over them all. This left just the dark blue neckline, or rather the dark blue neckline that is over a band of congestion formed between roughly late August 2023 to early January 2024, between about 183 even to 189 even. I said 4 weeks ago, and I quote, "I'm not sure how good this band of congestion really is. I'm also not sure how good the dark blue neckline is as a resistance, without the help of the 50% absolute Fibonacci line and the September 2021 low, but having come so far, it would be wasteful to not look further higher." Thus, looking at the triangle as a halfway hesitation, we could see a potential up as far as just under the neckline and above the 183 to 189 congestion, up in the 190.75 area. End of quote. Prices made a false but significant break higher 3 weeks ago, but 2 weeks ago they made a truer break higher, up through the August 2021 high at 199.20 and peaking just under the March 2013 high at 205.05. Now, I said just now how the break 3 weeks ago was false but significant. The reason why was because it helped define an early March to date bull channel, currently at 194.05 to 207.90. And though it was part of a weekly key reversal down, the action 2 weeks ago justified that weekly key reversal down as a false break. So what have we in the way ahead? Well, we have congestion at the previously mentioned March 2013 high at 205.05, then the 2022 low at 206.5, and the 2013 high at 215 even. But to be honest, none of these jumps out as being immediately significant. That's the congestion in the 2017 area around the July 2023 high, which has a small double top back then, Adam and Eve time. Perhaps that might be a better resistance. However, yesterday was a first definitive close below the purple highlighted bull channel, as well as below the dark blue neckline. It's now up to the market to exploit that move lower if it does. If it does, it will not only have to overcome the previously mentioned congestion between 183 to 189, but also the congestion below between 179.70 and 181.70, which contains the long and short medium moving averages, as well as the September 2021 low and the 50% absolute Fibonacci line. Now, my current view is that despite the congestion seen back between roughly late August 2023 to early January 2024, that it may be the lower congestion that is the more serious. Why do I think so? Well, I just looked at the action in late April and May, and it seemed that the lower congestion is at the moment the more significant. We shall see. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Service International Limited. And here comes the final important bit.